Great. Well, good afternoon, everyone, and good morning to you, Lenore. Is it still morning in the U.S.? I guess so. Thanks for joining us from there. And yeah, very sorry about the technical difficulties, but we think we've got them worked out. It's a really huge conference, hundreds and hundreds of people here, 5 or 6 rooms, and we're actually not in France, we're in Germany. So that's anyways, that's the name of the room. So I'd like to get started off with our panel. We have a fantastic collection of people on our panel. Really glad that you all volunteered. And the name of the panel here, for those who wanted to go to France, not Germany, is Does the Stock Market Drive Inequality? So it's supposed to be a provocative question, but we have many dimensions to discuss today. And but before I get to the questions, first wanted to introduce our distinguished panel of speakers. First of all, there's Lenore Palladino joining us from the United States. She's an assistant professor in the School of Public Policy and the Department of Economics and a research associate at the UMass Amherst Political Economy Research Institute. Her research centers on corporate power, stakeholder corporations, shareholder primacy, and the relationship between corporate governance and the labor market. And prior to her academic career, she worked as a trade union organizer. Alrighty. Thanks for joining us from the US. And then we have Stan de Spigliere, sorry. I've known Stan for, okay, no comments there. Director of, just can't pronounce Dutch, sorry. Director of Policy and Research at Uni Europa. And prior to that, he was a colleague of mine at the European Trade Union Institute. He has very broad research interests, which include European Works Councils, industrial relations, and workers' participation, and not last on the European Participation Index, which you'll hear a little bit about later on in our presentation. And then another online person joining us from Poland, Alexandra Palinska, who is Senior Research and Advocacy Officer at Finance Watch. Her expertise covers sustainable finance, corporate governance, and capital markets regulation. She is very deeply involved in current policy making in Europe on sustainable finance. And I should mention, we've been fighting in the trenches together for how long? Half a year, more than half a year, on the European Sustainability Reporting Standards, which you might have heard yesterday we had a huge victory. The Council and the European Parliament have agreed on a very ambitious set of amendments to the Commission's proposal. So I think we're going to get really decent reporting on impacts on people and planet by roughly 50 to 60,000 corporations in Europe, and also non-EU companies are included as well. So anyways, yeah, thanks for joining us all. And yeah, I'm Sig Vitols. I'm Senior Researcher at the Social Science Center Berlin and Associate Researcher at the European Trade Union Institute. So we've kind of arranged a kind of set of questions to kind of motivate the discussion before going to the Q&A. And again, this session is called, Does the Stock Market Drive Inequality? And first we're going to invite Lenore to talk about, well, what do we mean exactly when we're talking about the stock market? I mean, what is the stock market? What do we mean by the stock market? And is it a proxy for a broader set of phenomena? So I'll hand over the floor to you, please, Lenore.
Great. Well, thank you so much. How's my sound?
Perfect, perfect.
And I can't tell, are there people in the room as well, or are the participants all online?
This is a mix, it's a hybrid. So
okay, great.
I think there's 79 registrations altogether. So
great. Well, thanks so much for having me. Greetings from Northampton, Massachusetts, which is where I am, where it's about 10:30 on a very rainy summer morning so far. So I'm an assistant professor at the University of Massachusetts Amherst, and really always love getting to join folks in Europe who are thinking about the intersection of labor, business policy, financial policy. So it's great to be here. So what is the stock market? Sig asked me to start with that, and I don't know that I can do that justice in just a couple of minutes, but I'll give you a couple of my thoughts, which is maybe intended to be a little bit provocative, intended to be maybe why he asked me to speak. So the original purpose of the stock market was, of course, to provide financing for economic activity in the real economy, right? To provide resources for real investment by corporations who 100 years ago were emerging from a very different economy of small proprietorships to really build the industrial economy that we see today. I don't think we can talk about what is the stock market without actually talking about what is the corporation, right? We have to return to sort of first principles. The point of the stock market was to provide financing for the corporation, and we, I think, need to ask if that purpose is still being served today. So what's a corporation? A corporation is a special type of business entity that's given permission by the state, by the government, to operate with special privileges, such as in the U.S. I'm talking, I can really only talk about the U.S. context, but much of this is broad, of course. To operate with limited liability, perpetual existence, and other privileges that differentiate the corporation from other types of businesses. But the underlying purpose of a corporation is to be an innovative enterprise, right? To produce goods and services over time that hopefully become better quality at the same unit cost over time, that involve ideally different groups of stakeholders, workers, as well as customers, shareholders, suppliers, and the state in the process of innovating. So the purpose of the stock market, what it is supposed to be the means by which financing is able to be channeled from large groups of people who contribute, anywhere from a very small amount to a very large amount of money to a particular entity. But it's supposed to be providing the financing that's necessary for the true purpose of the corporation, which is to innovate and produce over time. So, why I say all this is because I think that we still operate with that mentality today. We operate with a mentality that, at least on the publicly traded stock markets, that what's happening is that funds that are being invested by households are actually flowing to corporations for the purposes of innovation. And I would like to sort of make the provocative statement that, at least in the United States, at least on the publicly traded markets, by and large, that's not happening anymore. What's happened instead is that we've created a stock market as a market for trading, right? And especially in the US, we've created this market because we've construed retirement security for working families as dependent on stock prices going up, right? So we've created the stock market as a place where those of us who are fortunate enough to be able to have a little bit of income that we can save for our retirement years, we put it into the stock market. It gets traded back and forth among many, many financial institutions without, for the most part, actually reaching the underlying goods and services company for whom the stock market is supposed to exist in the first place. This trading creates opportunities for financial institutions to extract large amounts of fees. And the framework that's developed around the stock market, the idea of shareholder primacy, which is the corporate governance theory that corporations exist solely to maximize profits for their shareholders, really has moved us entirely away from this idea that corporations exist to innovate, and crucially for trade unionists, that workers are at the center of the process of innovation. We've really lost over the last 40 years the sort of battle of ideas, and in the US, certainly of policy, that would really, I think, more accurately represent what the purpose of the stock market is and what the underlying purpose of the corporation is. So I'm happy to expand on any of that, and we'll talk more about sort of specific data in sort of my next go around, but that's hopefully an opening start to what I think the stock market, what we think it is, and what it actually is today in 2022.
Fantastic. That's a great opening. And yeah, I know there's lots of debates about the changing function of the stock market, and lots of great scholars from the US as well as Europe working on share buybacks and the incredible amount of the short holding period for stocks and that sort of thing. So thanks very much for that introduction. I'd like to turn it over to now Stan now. The other part of our session's title deals with inequality. So we've talked about what the stock market means. What do we mean by inequality here, and how do we measure inequality?
Yeah, thank you, Sig. So thanks also for that question, because if you ask me to explain the stock market rules, I would have quite of a harder time than with this. So if we talk about inequality, obviously we have very much different ways of measuring inequality, but I think One of the two ways, or one of the ways that I found most intuitive, is the one that is used by the World Inequality database, and that's basically measuring the percentage of the national income that is going to the top 1% or the top 10%. So basically, if you think about it, in a perfect equal society, the top 1%, it wouldn't be the top because it would be a perfectly equal society, should get 1% of the national income, and also the lowest 1% should get 1% of the national income. So that would be a perfectly egalitarian, equal society. Now, what we see is that in most societies that's not the case. There is inequality, obviously, and I've taken here from the World Inequality database, so two of those measures. So the lowest graph is the part of the national income that is going to the top 1%, and we see that it's between 8 and 11%. And if you look at the second one, is the share of the part of the national economy that is going to the top 10%. So if you take those 10% highest incomes, how much do they get of the total national income? And that's between 30 and 35%. So what you can also see in the graph, so first of all, what we see is that there is quite, I mean, it looks low, right? A percentage of 11% or 30%, but it's significant because if the top 10% gets 35% of the national income, that means that all the rest, they get quite a lot less, and there's obviously a lot of inequality. The second thing that we see is that there is growing inequality. So this graph goes from the 1980s, 2021, and you can see that in both indicators we see that inequality is growing. Now, I think I will say two more things about this graph and about inequality in general. First of all, inequality, it's a problem, it's a societal problem, and there has been many researchers that have shown that much better than I can do. And I refer to what also Nicola refers to previously, the books of Wilkinson and Pickett and stuff. They can show clearly that it's a problem. However, it's also in Europe a political problem. If you look at the 2020 Eurobarometer study, the top priority mentioned by most of the Europeans is income inequality and poverty. So we see that in almost all countries in Europe, top priority by European citizens for the European Parliament is poverty and inequality reduction. And if you look at the European Social Survey, another set of data, we can see that in all the countries, more than 50% of the people say that yes, governments need to act on reducing inequalities. And since the 1910s, this percentage has been really on the increase. So we see a growing demand of the European citizens to tackle inequality. And one last thing that I would like to mention is regarding the problem of inequality again. And I think the best way to show that is by referring to what monkeys do, because you cannot really argue with what monkeys do, right? And I want to just explain you a small study, an experiment that I invite everybody to watch on the internet. Is what they do is they give monkeys a certain task. It's a stupid task, and the monkeys, they get cucumbers for that. And they can do it until they are really satisfied with cucumbers, which takes a long time because, you know, cucumbers, it's not much food. And on a certain moment, they bring in a second monkey, and the second monkey, he gets, or she gets grapes for the same task. And the monkey that gets the cucumber sees that the second monkey is getting grapes for the same rather stupid task. And what the researchers insert there is inequity. And what you see is that with those monkeys, this inequality creates a lot of, first, aggression, and second, strike. So basically, the monkey that gets the cucumbers refuses to work until the inequality is removed. So obviously, this is a stupid story about some monkeys, but it shows something. First of all, they also did it with a lot of other species. And dogs and all this kind of stuff, and they all show the same behavior. So what we see is that inequality is a problem not only for politics. That's what I shown with the Eurobarometer, but also for society. And if the story about the monkeys can tell us something, is that we need to reduce inequality in societies.
Okay, thanks very much for that, Stan. So 12 to 1. I mean, then basically your statistics shows that the top 1% are getting 12 times as much as they would get roughly if there was a completely equal society. So yeah, it's quite stunning. And of course, the corollary of that is that people at the bottom are getting less, and there are some rather shocking statistics on that too. Something like 20% are at risk of poverty still in Europe, and it seems to be getting worse in some countries. So, okay, thanks very much for that. So we'd like to turn to Alexandra now, please. Alexandra, you're very much dealing with the issues of corporate governance, and of course remuneration of top executives plays a key role in corporate governance. And Lenore mentioned shareholder primacy, shareholder value, et cetera, et cetera. And could you tell us a little bit about how you think about paying top executives and where that fits in this picture of growing inequality in the stock market?
Thank you so much, Sig, and hello, everyone. It's a great pleasure to be here today. I must say, with my background as an economist, and also having actually worked previously for an association representing the interests of publicly listed companies, and later on asset managers, I probably have a bit of a kind of a particular background. However, now I work for a Brussels-based NGO and expertise center with a mission to make finance third society. Hence, obviously, I'm much more free to speak up openly, also my mind, and basically see what the facts say. And well, as Finance Watch, indeed, we are actively working on, well, as Sig mentioned, Corporate Sustainability Reporting Directive, and, well, the accompanying standards, and importantly, sustainable corporate governance, elements of which have been included in the Commission proposal for a Sustainable Corporate Due Diligence Directive, proposed actually earlier this year. And as you may know, actually, well, what was earlier supposed to be named as Sustainable Corporate Governance Directive has been a subject of very fierce business lobbying, especially actually the core corporate governance aspects, including directors' duties and the remuneration. Since basically very beginning, well, I would say since beginning, after I have joined actually Finance Watch, I started working on this subject, and we have responded to the Commission consultation, and we have been pleading basically to align a proportion, ideally 50% of directors' variable remuneration with sustainability targets, basically to put financial and sustainability performance on an equal footing. And basically, that has been the main aspect we have been focusing on. And indeed, we have been challenging the fact that, well, currently, quite frequently, directors and especially executives' remuneration is basically linked with the share price, which at the end of the day can lead to certain perverse effects, and indeed it's not very conducive to long-term or sustainable performance of even the company itself. And actually the tricky bit is that when we do talk about actually putting financial and sustainability performance on an equal footing, we would rather suggest that maybe the remaining 50% of directors' variable remuneration be linked actually with proper financial performance of the company rather than the share price, which, as we do know, is often not representing the intrinsic real value of the company itself, can be basically, going up and down depending, I would say, on market movements, various crises, and as well as basically, in some cases, rational investors' reactions, right? Because they are not always, I would say, driven by rationality or proper, I would say, information and premises. But I think what I like to share with you here today is also what I further found out while actually preparing for this conference, which I think is actually quite shocking. I mean, already from the past, I do recall actually some conferences about capital markets, short-termism in capital markets, and maybe a little bit of a reflection on the history, how capital markets look like in, for instance, 1950s, 1960s. And some people actually recalling some academic professors saying, well, look, at that time, okay, fine, maybe the CEO's compensation was, several times higher than remuneration of an employee. However, the differences were not as huge as they are today, right? And that I think actually it was even in the movie also Big Short, where they have been actually referring back to remuneration, not only actually of company executives, but even, I think of top positions at, I think, Federal Reserve. I mean, the actually compensations were very, very different to what we see today. And in the preparation of this conference, I found some, pretty much, I would say, shocking figures. I mean, unfortunately, they relate to US. I mean, unfortunately, in a sense that, it would be also nice to actually have some EU focused data. But I think, at the end of the day, probably the differences are not necessarily that huge. So there is a very interesting report by the the Economic Policy Institute, which estimates, well, they basically did analysis of 350 largest publicly traded companies in US. And they estimate that the CEO compensation has grown 1.322% since 1978. While typical worker compensation has risen just 18. So 1 point meaning 1,322%. In 2020, CEOs of the top 350 firms in US made 24 million US dollars on average, 350 times more than a typical worker. I mean, I'm sorry, but it's sure probably I'm gonna now sound, as a kind of a huge anti-capitalistic person, but it is true that I think it is very hard to argue that this is something which is just. And then, in addition to that, Institute for Policy Studies also actually estimates that 80% of SAP 500 companies pay their CEO over 100 times more than they pay their median worker. That means it would take 100 years for an average employee at one of these companies to earn what their CEO makes in a year. And yes, well, basically, another interesting actually aspect commented on in the study is that CEO compensation reflects wages, bonuses, and long-term incentives, but most importantly, the stock options that a CEO has cashed in each year, as well as any invested stock. Stock-related compensation comprises around 85% of CEO compensation. And actually, one of the conclusions of this and other studies is that actually stock-related compensation is a key reason why CEOs earn so much more than even high earners. And well, lastly, not to bore you too much with this data, it used to be that in 1950s, 60s, 70s, CEOs made 3.3 times what a top 0.1% earner made. Now it's more than 6 times. Well, so basically, I think all of that shows that indeed we do have a problem and that there is a huge discrepancy. And, the bottom line is, well, of course, being a CEO or, high-level executive, it is a lot of responsibility. It is true that these people often tend to work very, very long hours. It is stressful. So obviously they have to be compensated accordingly to that. However, indeed, I think it can be questioned what is adequate to that end. And I think also in the current circumstances of, well, basically the looming climate crisis, I think we also really need to kind of try to move away from this kind of financial performance only kind of thinking and really try to move towards a kind of a more sustainable value creation, and indeed, ensure more, just an equal approach. And I think, something which is like a great pity that eventually has been lobbied out from what was supposed to be sustainable corporate governance directive is the fact that originally this directive was supposed to address the root cause, the short-termism in capital markets, and the issues with the prevailing shareholder primacy model. Because actually, if you read some of the studies, in many cases, actually the shareholder primacy model is also being accused as the reason for why actually the executive pay has increased so dramatically in the last decades. And that at the end of the day, it is true, if we look at how executive compensations are set, and by the way, I think this is no secret to say that actually they hire dedicated specialized lawyers to make actually their compensation schemes so complicated that they are completely incomprehensible to any other human being. So meaning that actually, even if later on it will be actually disclosed in line with the Shareholder Rights Directive and voted by investors, I think, sometimes it can be also questioned to what extent actually a person will understand the real implications and the real monetary value of actually these compensation schemes. But yes, also, yes, the reasons for why it has happened, I think it's the prevailing corporate governance model. So I think it's maybe not only necessarily about stock markets as such. I think it's about the current corporate governance prevailing model and the fact that it is in the best interest of company boards, executives, who have very often very nice deals with investors or agreements, unspoken or well-spoken but not written agreements. And I think indeed it leads to this situation where I think there is also a big debate about shareholder payouts, right? And the cases where actually certain companies do not perform that well, they actually underpay the workers, but there are like huge actually shareholder payouts. And probably, to some extent one could wonder like, yes, are there some kind of, like deals and basically, okay, I cover your back, you cover mine, and at the end of the day it somehow works out. Okay, fine, you ensure that we have high compensation for our executives, you also get a nice deal. So at the end of the day, I think what we really need to move to is a kind of a stakeholder based, I would say, model where indeed companies and company directors consider the interests of all stakeholders and not just shareholders. And by the way, I do wonder whether actually this is gonna be publicly broadcasted, because I do risk that maybe after this speech, I will be never hired by a private sector again. But look, at the end of the day, I think it's not really about being, anti-capitalistic, but I do think that we do need to move into a more kind of a sustainable capitalism, kind of a stakeholder capitalism model, and ensure that we basically companies and our basically economies transform into more sustainable ones. Thank you.
Thanks very much, Alexandra. Well, I'd like to note that World Economic Forum has also called for a stakeholder model, and so I think you're still okay in terms of the World Economic Forum, but certainly the numbers you mentioned, I mean, Stan showed 12 to 1 in terms of the top 1%. You're mentioning figures like 100 to 1, 350 to 1. So obviously it's these CEOs who are driving a lot of this increase in the top pay. So, and then certainly, yeah, changing the way CEOs are compensated would be one approach. But I also like to, there's a lot of research mentioning so Stan mentioned the grapes and the cucumbers amongst the monkeys. It's called the leapfrogging effect. So like no CEO wants to be in the bottom half of the compensation scale. So they always, do the best they can to get into the top half. They don't want to be left behind, and that's a lot of what's driving this increase in CEO pay. Great. So we've been talking about the top percentages. Now we'd like to talk about what's happening at the lower end of the income distribution. And Lenora, can you talk about that? I mean, what does the lower part look like, and does the stock market have to do also with the lower end of the income distribution, and what's driving that?
Sure. I just shared a couple slides. Can you see them all right?
Yep.
Okay, great. So, first of all, I love being with Europeans because I love the fact that people are still surprised and scandalized by the statistics that Alexandra talked about in terms of CEO pay. And yes, it's true. Every time we get new shocking statistics, a few years later, they're worse. I remember there were definitely some conversations in the US, at least at the beginning, sort of when President Biden won the election, that we were going to see major sort of changes and transformations due to the pandemic in terms of corporate governance and top executive compensation. And I was cynical then. I'm still waiting now, but we're fighting hard. So, there's so much we could say in terms of the reality of income and wealth inequality. But since this is a panel on the stock market, I thought I would talk specifically about, I think, why the idea or the myth of shareholder democracy is so strong, certainly in the United States, and why I think it's really an incorrect one. So what I mean by that is a lot of the sort of public narrative and rhetoric around why the stock market is so important, why it's the metric that people focus on so much when they're thinking about the health of the economy, is because there's this idea that we're all shareholders. This has been perpetuated certainly in the US and in the UK. Again, I think primarily because we've tied our retirement security to the ups and downs of publicly traded shares, which has really been, I think, a long-term disaster in the United States. But the myth is very strong. There's been also this rise in the last, couple years in the pandemic of retail trading, meme stock tradings. I don't know how much the sort of story of GameStop and these sort of trading manias penetrated outside of the US in the last couple of years. But there's been a real sense that the stock market is, everyone benefits from the rise of the stock market. So what I wanted to do is just show you a couple slides that show you actually who owns stock. And the top line is that in the United States, it is white, wealthy households who own almost all of corporate equity in the publicly traded markets. What's happened, as you can see in this first slide, this breaks down ownership of corporate, and these slides are all from the Federal Reserve financial accounts of the United States, distributional financial accounts. This shows that, of course, in aggregate, the level of value of stock market value has been rising, and this shows the breakdown by wealth percentile group. And you can see, of course, that it breaks down very similarly to what Stan showed in terms of Europe. The top 1% owns the vast majority. But what I think is interesting is, let's see if I can go to the next slide. When you go from looking at levels to looking at shares in terms of the share of ownership breakdown between the top 1%, the next 9%, the next 40%, and then the bottom 50%, you can see that things have been roughly steady. The top 1% owns about half of all corporate equity, and the next 9% owns almost all the rest, right? And then there's sort of our professional class who owns a small amount of the total. And when you look at the difference between the level has been rising, but the share of who owns what has been relatively steady, I think that helps explain in part why we have this mixed perception, why we have this really false perception. So when we look at the stock market's been going up and up and up until recently, now we're having a big change perhaps in terms of entering bear market territory, but we saw, rise in the stock market for many years, and that was pointed to by both in the US, by both Trump and Biden, by both Republicans and Democrats, as indicating something about the health of the economy, indicating something about the idea that the people who were, working poor, people who were middle class were going to be able to benefit from this. But this is really a myth. The corporate equity is by and large owned by the wealthiest, always has been and will be unless we see significant changes. And then I'll just show you, because of course in the United States, histories of racial stratification and racism are so strong. The same story goes in terms of who owns corporate equity, it's owned almost entirely by white households. Hispanic and Black households own almost very little of it. The category of other has been changing for reasons that I could talk about if anyone's interested, but it's by and large owned by white households. And you can see again, there's been this growth, but also there's been, in terms of the share, it's been owned by white households up until the present day. And again, no reason to think that that will change. And then the final point I'll just make is that there's a lot of discussion in the US about the racial asset gap, the racial wealth gap generally, but about specifically the gap in assets. And our main focus is always housing, right? Housing is a major asset for households. It was, of course, a major driver of the financial crisis. And in the US, Black households lost as a percentage of household net worth far, far, far more than white households. But the gap in corporate equity ownership has also been rising, as this graph is one that I made that shows the percentage of the corporate equity gap to the overall racial asset gap. So it's a chart just of changes over time. But the point is that we have in the US, serious income inequality, but even more serious wealth inequality, where, deeply stratified by really the top 10% versus everybody else, and by white households owning almost all of corporate equity. And the punchline, or what this says to me, is that ultimately, I don't think that we should be thinking of the stock market as a solution to income and wealth inequality. I think we should be thinking about corporate productivity and rewriting the rules so that people who work in corporations, who create the value of corporations, are able to better bargain for a larger share of that value creation, through trade unions and other important institutional changes. But I think that when we look at, somehow the stock market will help us actually reverse some of these dynamics in terms of income and wealth inequality that are experienced by people at the bottom of the distribution in the US who are disproportionately communities of color, I don't think we're going to see those changes emerging from the stock market at this point.
Lenore, I had to make when I looked at your charts again, I had to do a double take because I thought the lower 50% was kind of this bar, but it's in fact, it's just a very thin red line, which is, you're essentially saying that the lower 50% basically own something like zero. So that's kind of a aha effect, as we say in Germany, at least, that when the stock market goes up, that's also a driver of inequality because so few people in the lower 50% are invested, so that it leads to this whole interest in having the zero interest rate policy or even negative rates as it's been in Europe, because the stock market keeps going up, and that drives inequality. So that's another key driver. So thanks for that. Great. Well, I'd like to turn to Stan again. So we've been talking. We've got a good outline of the problem, so to speak. Then the huge levels of inequality, the growing inequality. So what can we do about that? What are the solutions? Both at the top end and the bottom end. What kind of proposals do the European trade unions have for dealing with this?
I'm not sure if the mic, So now I will be speaking as both a researcher, but also part of Uni Europa. And so the slogan of Uni Europa, the trade union of the services sectors in Europe, is pretty clear, and it's forward through collective bargaining. And I would like to extend it a little bit, is forward through democracy at work. And before I explain what I mean with that, I think we need to just take 2 seconds to think about why we have political democracy. So the reason why we have, or one of the reasons, or one of the logics behind political democracy, is that we want to limit the power of the powerful, right? We wanted to limit the power of our kings and our presidents and our dictators or whatever they were. And we wanted to distribute it more equally in society. Second thing is we want to make sure that that the power in place is held accountable for their actions. So when they do something, they need to explain why they're doing it, and if they do it wrong, they need to be held accountable for that. And we want to increase the control of the citizens, of the people, over the political trajectory of the country. And I think that you can apply perfectly the same reasoning on democracy at work. So if we're in a what accounts basically for democracy in society also accounts for democracy at work. You have in a company you also have one person in charge, the employer, and democracy at work. What is the reasoning behind it? Is to limit the power of the employer. Is to make sure that the employer is accountable for the actions that he or she takes, and that the workers, the employees, have a certain amount of control over their work. So this is the idea of democracy at work. And what we have done, or what mostly actually you have done, to be honest, Sig, is developed an indicator for that, which is called the European Participation Index. And I have taken the liberty of using and abusing that indicator throughout the last couple of years. So what this indicator does, and I will just shortly explain it, is it looks at three things. It looks at whether there's workplace representation. So the idea of the employee having control over their work, workplace representation. Second, whether there's collective bargaining and trade union density in a certain country. So the idea is here that the power of the employer is limited through collective bargaining, that the power of the employer they have to follow certain collectively agreed rules. And the third one is board level employee representation. So again, this idea of employees having a certain amount of control over what's happening in the company. And this has been taken together in what we call the European Participation Index. And what I think is interesting, and we can go maybe 2 slides ahead, is that we consistently see that those countries, so the dots basically on the horizontal line is the different countries and their score on this European Participation Index. And on the vertical line, we have the top 10% share of the national, so the share of the national income going to the top 10%. And what we consistently see is that those societies that have a lot of democracy at work are also more equal societies. And here it's the top 10%. But if we look at other indicators, we see the same pattern. We also see that where there is democracy at work, so where employees participate in companies in various ways, we see that employment levels are higher. We see that innovation is more, that there's more patents required, that there's more investment in innovation. We see that also more importantly, political democracy is stronger. So we see where workers participate in companies, they also tend to participate more in politics. So if you ask me, maybe one more slide to show you is to illustrate a little bit the thing. What we've also done recently is look at the evolution over time, and we took one specific indicator of participation, which is collective bargaining coverage. And what you can see in those 3 graphs, basically, it's for the UK, Ireland, and Germany. The blue line is collective bargaining coverage over time, and the red line is again the percentage of the national income going to the top 10%, so an indicator of inequality. And we can consistently see where and when, and mostly when, collective bargaining coverage declines. So when participation at work declines, we see inequality rising. So why is that? Or at least what's one of the explanations for that? And I think Nicola Contouris in his opening speech rightly said so. Inequality is made in the labor market. Inequality of income, basically the groundwork is laid in the labor market and in the companies. And collective bargaining, what it does is fighting the inequality before it has to be resolved. We call it pre-distribution, not redistribution. Not when the inequality has occurred, correct for it through all kinds of government policies, but before it's happening, correct for it before the income is distributed, before basically the cake is divided in the companies. And I think this is an idea, pre-distribution, and this is a method, collective bargaining, that we have to let's say revalue. And I hope that at least I've heard somebody being too pessimistic in life. I'm always too optimistic in life. I hope that with the European Union currently, the policies that are happening, that we really see a revaluing of collective bargaining. And I hope that these graphs, the blue lines will go up and that the red lines will go down again.
Yeah, thanks very much, Stan. Yeah, it's good to be optimistic, and I'm an optimist too. It might be worth mentioning here, we had another big victory with the minimum wage directive, which kind of sets a goal of, I believe it's still in the final agreement, 70% collective bargaining minimum per country. So
80%.
now it's 80%. Okay, so the European Parliament got its way. So okay, so I think that's a huge victory, at least to have a norm of 80% of people represented by trade unions and collective bargaining. So yeah, there's reason for hope in Europe on that. Okay, I'd like to turn to Alexandra. So we've been talking a bit about what to do at the lower end of the distribution. What about the upper 1%, the 5%? So you mentioned sustainability, tying kind of remuneration to sustainability targets. Can you tell us a little bit more about how we do that and how you think about that?
Well, I think definitely this is something that has to be reflected on properly, right? Because we don't necessarily want to create a one-size-fits-all solution. I think on one hand side, it is really important that maybe a proportion of that is linked to climate targets, net zero targets, especially in light of the looming climate crisis. But at the same time, I think it might be actually worthwhile now here in the context of inequality to also reflect on maybe certain social targets, right? And looking at that. Although whether, for instance, this is a perfect solution for here, I would say, dealing with this quite complex actually problem, I'm not entirely sure. I think what really would help is to somehow transform the prevailing corporate governance model from the shareholder privacy to a kind of a stakeholder capitalism model. And I think, for instance, in terms of that, including somehow incorporating employee or trade union representatives on company boards, even if it's something hated by companies, I think is an important step forward, right? Because although, okay, I think we probably all also heard about what sometimes happens is that then company boards, they have separate meetings just for the, regular directors and then a separate one including the trade union representative. But well, at the end of the day, even if that happens, I think it's still better than nothing. And I mean, what you just mentioned about collective bargaining, this is really essential. And it's also something that has been debated in within the platform Sustainable Finance, and in particular the social subgroup of the platform, in the context of minimum social and governance safeguards that are like one of the elements of the EU taxonomy, green taxonomy, but at the same time also in the context of the social taxonomy, well, if it will ever see the daylight in terms of a regulatory proposal. And, on one hand side, it's a very tricky issue because I think collective bargaining is very controversial. So in general, one could say also, in terms of the merit for a social taxonomy to go forward, I mean, whether we want to include it in there or not, well, that's a question mark. But I think there is quite a lot also happening at the EU level. I mean, also in the context of the EU pillar of social rights, and there are, many other initiatives. So I think. Who knows, maybe with the quota with regards to gender diversity on company boards, maybe that will somehow help as well. Because, I do think that, the better diversity of company boards, not only in terms of gender, but in general, cultural, in terms of the backgrounds, that could also maybe a little bit help the current situation where, sorry for saying that, but I think still many company boards look basically like this, that it's just, old men, kind of club, friends from school, from the Ivy League, deciding, what to do. And I think, if you have a little bit more diversity on company boards, hopefully that would also lead to, I would say, more inclusive and equal approach. So I think in general it's not a very easy to settle. But yeah, and another idea, could be also to, well, as you know, we have already a revised shareholder rights directive, right? I would say implementation has been, and I would say transposition of the directive has been taking, for ages in Europe. So it's still, early days in terms of actually seeing, to what extent it has improved directors' remuneration related disclosures. But I think in, I don't know, 2 years' time, it could be very interesting to see some data on how it was transposed across different countries, what kind of changes did it bring? Because, for instance, there was also an option for, a binding vote, well, for shareholders in this case, on directors' remuneration. Who knows, maybe in some countries they could even, introduce some kind of a clawback clauses. But in any case, we do understand that there is a review foreseen, in the future. And I think the Commission will even already in 2023 start considering, how the current application and, what effects it has brought. So I think we could also, for instance, look into the next Commission's mandate. And then basically once there is, I would say, once actually there will be the work starting for a next revision of shareholder rights directive, it could be also an idea to, yes, introduce, some additional provisions like indeed collective bargaining or basically workers' representatives on boards and any similar approaches. But again, I think, we have to then to be ready for quite a battle, because obviously, company representatives will be very fiercely battling against it.
Okay, thanks for that, Alexandra. Should mention the issue of voting on CEO's pay is a bit controversial. I mean, basically in countries where we had workers in the boards, they were concerned that would result in a power shift away from the boards, the co-determined boards, to shareholders who are often driven by short-term interests. But certainly pension funds were very, very interested in having this additional kind of means of power and influence. So
yeah, just to maybe very,
yeah, sure, go ahead, yeah, please.
Yeah, just to maybe very quickly mention, like, I'm not sure well, for sure it's controversial, but I think, all these aspects are. And I think the biggest problem with us as humans as such is that we hate change. And whatever is actually challenging the status quo, and especially when it's related actually to compensation, to actual incentives, is always very controversial and very hard to change. However, that's not the reason not to try to change it. But as I mentioned, for instance, I mean, giving more power to shareholders could be helpful, but it will not necessarily resolve all the problems, as I mentioned, either, because then at the end of the day, it also depends on a given shareholder, right? And how dispersed is the ownership of the company. So once again, I think it's quite complex, and we have to look from different sides. But just maybe also one more thing to mention. I mean, indeed, in the context of the corporate sustainability reporting, I do hope that maybe with the new European sustainability reporting standards, and improve disclosure on social matters, that you have been instrumental to actually help also shape. I do hope that will somehow, improve maybe a little bit the situation as well. And also in the context of remuneration and whether there are parts of it links to sustainability targets.
Okay. Well, I hope so too. We got in disclosures on fair wages, living wages, and also on the extent to which CEO pay is linked to sustainability targets. So I hope this survives the consultation period. So I think, Stan, you wanted to jump in on this point?
Yeah,
right?
exactly. As you said, I have a broad interest. So I also looked into a little bit of the CEO pay discussion. And when I was doing my PhD, I was doing my PhD on basically on HR issues. How do workers, how do employees behave at work? And one of the main conclusions there always was money is not so important, right? They always said, it's about intrinsic motivation. You have to search for those employees who want to do a good job, who want to, who find the job interesting, etc., etc. And all this financial stuff, you don't have to look at it too much. However, if you look at the CEO pay discussion, suddenly it seems that CEOs are not humans. They seem to be from a different planet, because it's all about money and it's all about financial incentives. And the discussion on CEO pay is about how do we tie the exact correct incentive in order to steer the behavior of that thing that is not a human, but that is a CEO. I call this the double discourse on CEO pay, right? As if they are from a different planet. And I think obviously the solution